Well, hello and welcome to Best of Global Mantra Outlook 2014, a year-end special show which gives you a snapshot of what the big money managers are feeling about world markets and the global macro environment into 2014. We start the show with an assessment of the U.S. economy. The U.S. markets are at record highs, and the big question there is, will the market see a correction from here, or will the markets break out higher given the recovery in the economy? Jim O'Neill, former chairman Goldman Sachs Asset Management, believes that it gets tricky for the markets.
The markets are really strong. I'm talking about the US, sort of October through April, and then you've got to be careful. And a lot of me thinks, well, why will that not just continue? So long as the Fed doesn't taper and then send a hawkish message with it, I could see the markets rallying, the US markets rallying further. That said, it's not cheap. You look at the forward PE, which I spent a lot of time doing in the past. It's not cheap at all. So if bond yields were to rise more than the Fed would like, or they would be not capable of stopping it, I don't think that would be good for the US market. So, going back to what I said at the start, I think it's going to be a bit more opportunistic. I don't see a straight line rally. To me, the past 5 years since 2008 or early 2009, it's been easy to be bullish on the US. Now I think it's a bit trickier.
And while the dollar's strength is directly linked to tapering, Jim believes that a strong greenback is not what the US wants at this point.
This is a year where many people thought the dollar was going to do well because it was the least of the worst. But what they underestimated was the strength of the Fed's dovishness. And with Yellen, I'm not sure it's that easy for the dollar to rally much. And another thing related to it that people forget, the US does not want a strong dollar. The US wants to export just like everybody else. So I don't see the chance of a big rise of the dollar against any major currencies. I wouldn't want to make a big bet on the dollar.
However, Kevin Gardner of Barclays is bullish on US equities as he feels that money will chase growth into the new year.
It's been our favourite stock market, along with continental Europe. We also like it in the last year. So we've been pretty positive, but ourselves, we're expecting some sort of technical correction. The issue is, will it be a big fall and will it be a lengthy fall? And our guess is that it might be neither of those things, because actually we disagree a bit with the point you made there. We don't think valuations are sky high on the US market. We think they're actually pretty unremarkable. And some of the valuation metrics that we see people using, we find all sorts of weird and wonderful things being rolled out, such as Tobin's Q ratio, cyclically adjusted price earnings ratios, which depend for their accuracy on data that are more than 100 years old. We're not convinced that those valuation metrics are telling the right story.
Well, while the reason for an upside to US equities is clear, Russell Napier of CLSA believes that the market isn't talking as much as it should about the risk of deflation that could potentially bring about a big sell-off in equity markets and actually asset prices across the globe.
I think we're bracing ourselves for the word deflation. It's an important word. It doesn't happen often. It certainly hasn't happened often in the modern age. But when it has come along, it's been incredibly dangerous for the owners of equities. The reason why it's been so bad for equity owners is we often call them assets, but equity is the fine sliver of hope between assets and liabilities. And when you get deflation, you begin to undermine corporate cash flows at a time when corporate expenses might be staying high. So we raised this issue of the very survivability of equity when we raised the word deflation. Now, Mario Draghi very kindly also raised the word in the week just past. And if we look around the world, I can see 2 or 3 big themes for deflation in 2014. It's never been a good word for equity investors. And I think that applies just as much to America, despite the fact the market keeps going up, as it does to other markets in the world.
In fact, Russell believes that falling inflation is what will lead all markets lower into 2014 if it were to happen.
I strongly believe there's going to be a fall, and as I said, I think the market has benefited from inflation coming from 4%, where there was a risk that the central bank would have to tighten to 1%, and that's what's happened in the 2 years you mentioned. From September 2011 to today, inflation has come down, and that's benefited the market. But from where we are today, either inflation is going to go up towards 4%, which would be good for the market. I don't think people will begin to get too worried about the market or inflation roaring through 4%, or it's going to come down, in which case the market is very clearly going to come down.
In fact, the main risk of deflation is in Europe, but Nikhil Srinivasan of Generali feels that the risk is not for real as of now, and that Europe has indeed got its act together.
I think what Europe has to worry about is the very low inflation prints that are coming out. And what I looked at the numbers this month, there was CPI at 0.8. And I'm not a deflation scare person. I'm not saying Europe is heading into deflation, but there are lots of similarities between Europe today and Japan in the 90s, where you had low growth or no growth, essentially no inflation, very strong currency, and very driven by a very large current account surplus. So what Japan is a reminder of what can happen. You can be in a funk for a very long time. And I think what the European Central Bank is doing is trying to ensure that funk doesn't happen for a very long time. And so this is one of the outputs of that, and that is you cut rates again, and they've cut it to 0.25. I don't think we see deflation in Europe, but I do think there's a fear of extremely low inflation, which is worrying in its own.
Nikhil, at this point, in fact, has a big overweight in Europe. He believes Europe is a forgotten story that could perhaps show potential in the new year.
I still think Europe's a forgotten story, honestly
Okay.
speaking. You've had a rally, everyone's talking about it now, but no one's really looked at it properly. And I think there are lots, if I was a stock picker, there are lots of forgotten stories in Europe. And so the forgotten stories are going to be, so Europe's a huge economy. The EMU is the largest economy in the world. Okay, it still is, I think so, right? There are going to be opportunities, right? And Europe has some great companies. You've seen the big export companies. You have the local company. I think as people realize that Europe, A, is serious about reform, okay, and B, companies themselves are restructuring. The comment you made earlier, when are they going to clean up their balance sheets and all? People are going to get more optimistic. This is not an optimism based on earnings are going to pick up in the next 18 months. This is an optimism based on, you cleaning up your balance sheet, so when growth does come back, you're going to benefit particularly strongly from it.
Well, another strong view for 2014 came through on Japan, as monetary easing there would not only fuel the Japanese markets, but also bring about interest in emerging market debt and equities. Jim O'Neill has a strong view on how this money could actually reignite interest in the EM world.
People go on and on and on about Fed tapering, but you look at the scale of what the BOJ's doing, that has global ramifications. And I suspect behind the scenes, the infamous Mrs. Watanabe is probably slowly buying more and more emerging market debt and equity. So I can imagine that that's going to at least continue, if not possibly accelerate.
The big question next is, of course, whether emerging markets will catch up to the rally the developed markets have seen in the last 2 years.
Let's think about what are the drivers here. There are two things that really drive equity markets. First one is valuation, and the second one is earnings growth. So what's driven up European and US equity markets has been they were valuation, they were coming from very low levels, and they have seen recovery in earnings. So there's been no need to buy emerging market equities. So when we look at, so how is 2014 going to be different? Valuation has come down for emerging markets, and we have quite a high degree of confidence that emerging market equities are trading at an attractive valuation. Whether they outperform is really going to be driven by whether the earnings that the market is currently expecting comes through in 2014 or not.
Again, the whole Fed tapering issue is going to be there all the time. And going back to the only year that's been a really bad year for bond markets in my professional career, 1994, that wouldn't generally be good for all emerging market asset classes, including both bonds and equities. So I think it would be dangerous to believe that EM can outperform significantly against that background. That said, what the Chinese do specifically about the growth of the RMB and opening up their own markets, that could be a really positive for the EM world.
And within emerging markets, there seems to be growing focus on China, as it could be the growth engine which propels EMs out of their prolonged slowdown.
For the emerging world, China is very important. And I think we saw the trough of Chinese economic growth in the last quarter, middle of the year. Last set of numbers we got were better. The PMI is starting to look better. So I think the outlook for China is better than it was in the first half of this year. And China is a key driver for the rest of the emerging markets. So if we think that economic growth in China is going to be on an improving trend in 2014, that should be a key driver.
In fact, Chinese equities, which have been cheap so far through 2013, could be in for a rally as policy measures strengthen resolves to make China a more domestic-linked economy than one reliant on exports.
I think China can continue to grow. What is the 6-7% thing versus the 10%? Okay, I mean, so what? I think, can they do it 6-7 for the next several years? Yeah, they can. You know, I'm on the optimistic camp as opposed to the world's going to end in China camp. And again, there are issues. There are certainly issues in terms of investment or malinvestment. It's a sensible, thoughtful, clever government, okay? And I think that everything you and I know, they know, okay? The question is, can they do something to work it out? They're not going to be able to give you 10% growth, for sure. But they're going to give you something that's acceptable. I think Chinese stocks are not expensive, okay? My own sense is that this could be the time to actually buy Chinese stocks. So in the 3-year view, since I've talked about 3-year views before, I'd be long. In emerging markets, the stocks I'd be long would be Chinese stocks, period. If you ask me one country, China. Buy China, don't worry about it.
Talking about India, you know, it seems like everything boils down to elections. If India gets a stable mandate at the center, there is no stopping the breakout for the Indian markets as also for the economy.
Pending how the opinion polls go, as we're seeing now, the prospect of Modi becoming leader seems to be regarded as bullish, which I think makes a bit of sense. Not predicting that he'll win, but if he did, it would be bullish. I think it's quite an exciting year for India in that sense. You know, the past 2 or 3 years I've been quite openly critical of India because it can never get anything done. Now, as everybody knows, it seems that this guy can get a lot of things done in Gujarat. And so, in theory, if he can take that to the national stage and show leadership, you know, he talks a lot about this minimum government, maximum governance. And that's the sort of thing that somebody like me thinks India exactly needs. And if that kind of focus and decisiveness were present, many of India's so-called problems would be solved overnight.
From a foreign perspective, India is, you know, is quite a difficult market to read at the moment because we believe that the real driver going forward is going to be the election cycle, and that can give, you know, if there's a very positive election cycle that, you know, that Modi is going forward, and then that could be very, very positive for the market, or that's what the market's sort of believing at the moment. And then that's obviously quite positive, maybe potentially for investment. And I expect that if that momentum gets in the market will run. Now, whether the actual reality comes in with that is you know, is not to say.
I think the Indian stock market had a fantastic rally in the last few weeks. Maybe too far. There are two issues that they're just broadly speaking. One is the you know, you've got inflation, you've got an inflation situation, so relatively tight monetary policy cannot be loosened, okay, for the time being. Second, you're coming into election season, okay? So for those reasons, I'd say the market remains, you know, at best will remain stable here. The issue then is the market starts to speculate on the new government, and if they believe a new government is going to produce those reforms that are needed, the market goes up. So then the catalyst for me is the next election.
In fact, even the currency seems to have put a bottom in place with more potential for an appreciation from these levels. That's the common opinion.
I think the rupee will probably be in a stronger position than it is now, given the fact that the central bank is planning to raise interest rates. So there's a good chance the rupee will get stronger, probably not significantly stronger.
People have got so bearish about India and the rupee. And as you've just said with your question, it doesn't need a lot for things to get better. And so if you have that improving current account, and you have Modi, and you have a supportive cabinet, and you get a load of policies to boost FDI, you know, the rupee could be back in the mid-50s. It's not impossible.
Okay.
But
that could happen in 2014 itself?
Yeah, of course it could.
Okay.
But, you know, that's what I always laugh when people go on about this sort of mini crisis in India. You know, India's current account isn't that big a problem. The reason why it's a problem is because the government's been so weak India doesn't really attract much FDI, but lots of people would love to put FDI in there. Just as, in the days before we're having this discussion, Marks and Spencer's, a big UK retailer, announces it wants to invest more in it. You know, loads of people would want to invest a lot more in India. So if we had a more receptive environment, current account wouldn't be a problem. And if it improves, then it'd be easy for the rupee to rise.
Sean Taylor of Deutsche Asset Management believes that defensives have played out their rally and it's time to look at cyclicals such as cap goods, metal and engineering companies in India.
I think at the margin people will look to take on more risk in that rally because, you know, you can't get, you know, I would have thought that the mid-cap banks would probably do the best. The private banks, I mean, there's some obviously the HDFCs, etc., are very expensive, but I expect it's more in the, you know, ICICIs and the AXIS and the YESs and, you know, but people looking to try and take more specific risk. I mean, Larsen & Toubro's last results were pretty positive. I think the cyclical side of India is very different from the cyclical side elsewhere because it relies on also new orders. And, you know, we haven't seen that many new orders come through. That would be, people would be buying them in the hope that a new government put more investment in and new orders. And I think you've already seen that already in some of the Adani stocks. The ports have done quite well. Quite on the consumer side elsewhere, I think it's a very different equation. I think clearly rates coming up everywhere, you know, slightly, and the consumer has been growing quite quickly, and consumer stocks are quite expensive. I expect the long-term trend is really, really supportive, but except in the short term, people are prepared to look at cyclicals. If you are getting better global growth, then yes, we would look more for cyclicals. Tata Motors is an extremely good structural story. That is a core in people's portfolios. I mean, it's one of the really good winners in India. I expect if you do see more hope from the election, then I expect some of the other car companies which are more domestic orientated, you know, especially maybe, you know, ones that are, you know, sort of Maruti and Mahindra, etc., which are more local, you know, domestic orientated, would probably benefit as well.
We've been delayed in building the requisite infrastructure required. So hopefully after the election, the new government, whichever it is, whichever party, will start to make this a priority. And you get money, and if you start to get money domestically initially, foreign money will follow. I think this whole thing about getting foreign money sounds good, sounds cool, right? Let's get money from abroad. My point is get money locally. If you get money locally, the returns are decent, stable, steady, okay, then over time foreign money will come in, okay? Or you do joint projects, or you set up in India some kind of guarantee bank, guaranteed by the government, issued by the government, and the guarantee bank, whatever you want to call it, guarantees parts of these projects. So the government of India comes and says, okay, look, this bridge, we don't own the bridge, we don't want to own the bridge, we want to privatize this thing, but we'll guarantee 50% of the principal, we guarantee 60% of the principal, right? Then the credit rating of that bridge or that project will be higher. If the rating is higher, the cost of that project is lower. Okay, so that's great for the guy who's going to build the bridge and operate it. It's great for the guys who want to put money into this project because they feel there's a government of India guarantee. At least a large part of that principle is protected by the government. So be creative. Don't just say, we want to build a bridge, foreign money, where are you?
Well, and finally, if 2013 was a dramatic year, difficult to call for investors, 2014, stepping into the new year, one would need to be opportunistic as money making gets harder.
I think it's probably a year where one has to be a bit more opportunistic and seize the moment as opposed to just stick with an underlying view.
I was very cautious in 2013, which proved to be right for emerging markets, very, very wrong for the United States of America. I think there's reason to be much more cautious about 2014.
Well, it's always difficult to forecast surprises, but I mean, I think the issues that emerging markets face are, in my view, cyclical and not structural. And the pessimists would clearly say there are structural problems. I think those problems are cyclical, and I think that they're going to be less severe in 2014 than they were in 2012 and 2013. Now, if that view is correct, then you should expect positive surprises, rising expectations, and positive returns.
In very broad terms, we're still overweight equity markets. And we're underweight bonds in very broad terms. That tends to be how we're allocated. We are still very much focused on the US as the place to be. But of course, as the US market continues to rise, it's getting more and more expensive relative to the other markets. We do think that whether it's now or a little bit later, we probably will be increasing our allocations to emerging markets, because I think the equities, yeah, I'm thinking more equities here, because the valuations are getting more and more attractive.
Well, with that, we come to the end of the special show, the Best of Global Mantra Outlook 2014. Here's wishing all our viewers a very happy and prosperous 2014 from me, Tanveer Gill, and the entire team at ET Now. Have a great year, and thanks very much for watching.